Hello students, this is officially the last video that I'll be making for the semester, and this is of course, as you can see, the recap video for your exam that you'll be writing soon. If you do not know by now, I am Dominique Pierce and I'm one of your tutors for the semester. My email address is over here if you need to get hold of me, but I did also put a little picture of me so that you can put a face to the voice, because I always find it very strange to listen to a computer speak. So there's just a picture. You can put a face to the voice while you listen to this video and while we go through all the work. And then here's just a little quote for you to inspire you while you listen to this video and while you do your last bit of studying for accounting and for the rest of your exams. And it says, "I'm a great believer in luck, and I find that the harder I work, the more I have of it." So just a good luck for the video, good luck for your last bit of studying, and good luck for the rest of your degree and this year and the semester. Just good luck for everything. So these are the submissions that I got of stuff that people were struggling with. So this is what we will be going through. I do just want to reiterate that this video's intention isn't to reteach all of this work, because that would take forever. But basically what I have done is just broken down everything into little pieces so that you can maybe print this out or write this out and have this with you during the exam, just in case you get one of these questions or in case you get a question that might help you with this type of stuff. So like I said, I'm not reteaching the work, but we will be going through like key elements of each of these topics. Okay, so firstly, we're going to look at depreciation. And the definition of depreciation is the systematic allocation of the depreciable amount over the useful life of the asset. So there are three different types of depreciation. You have straight line, you have diminishing balance, and you have the production units. Then the depreciation is calculated on the historical cost of an asset, which includes all of those costs that are listed there. I'm not going to read them all out, but in the little blue bubble on the right, we can see that it says that a cost of an asset includes all costs to get it in the condition and location to be used by the business. So if you get a question with a bunch of costs, obviously all the costs that will be included are the ones to get it in the condition and location to be used by the business. So if that asset needs to be in the business to be used by the business and you have transportation costs, that will be included, for example. Then this was a slide on the depreciation slides that were put up by your lecturers. And this is actually a really useful slide. So if you already have this down somewhere, well done. If you don't, write this down, because this is very important. So basically what your lecturers have done here is they've taken the definition of depreciation and they've split it up into the three most important pieces. So you have the systematic allocation, you have the depreciable amount, and you have the useful life of the asset. So when it comes to the systematic allocation, you have the three different types of depreciation, which we've already discussed, and you will need to be able to choose the method based on pattern of expected future economic benefits and whichever will generate the best economic benefits in the future. Then they have reiterated here that the depreciable amount is cost price minus your residual value. So your cost price is obviously everything we discussed in the slide before this, and your residual value is the estimated amount receivable if the entity had to sell the asset at the end of its life. Now basically what a residual value is, not in a definition form, is it's basically the amount of money that you plan on selling the asset for once you have used it for the useful life in your business. So for example, if you have a car and you plan on selling it when you've reached 250,000 kilometers and you plan on selling it for 100,000 Rand, you need to take that amount out of your cost price to get a depreciable amount, because you obviously can't depreciate the extra 100,000 Rand because you plan on receiving that back. So that is basically what a residual value is. And then of course useful life is just the period that is expected for the asset to be used by the business, or the amount of units that will be able to be used or made by the business from that asset. So over here, I have put the formula or the formulae for the depreciation and all the different methods. I do realize right now that units of production is a bit small. I'm really sorry about that. I had to fit it into the bubble. But I did do an example, so you will be able to see the formula there. But basically, straight line is cost minus residual value times 100 over the expected useful life. That is pretty simple. You'll see I didn't even do an example on that because the textbook does explain that method quite well. Then you have your diminishing balance, which is your cost minus your accumulated depreciation times the depreciation percentage times however many months you have used it for that year. We'll get into that, but that is the formula for that. And then obviously units of production is your cost minus your residual value over the estimated amount of units that will be produced during the useful life of the asset. Alrighty, so here is an example of the diminishing balance method of depreciation. This one is very simple. I did only realize once I had copied it down. But you will get the gist of how this method works with this example. So my students know by now that I have drilled timelines into the head. Timelines are your best friend in accounting, I promise you. They will help you more than I can help you even. Timelines will help you. So please, if you get a depreciation question, if you get an interest question, if you get anything that has anything to do with different years of a calculation, please do a timeline. I promise you it will help. You'll see further down in the video we do actually discuss timelines, but for this question it's a very simple timeline. It's basically just 4 years. We are lucky because we purchased the delivery vehicle on the first day of the year, which really never happens basically, but we were lucky in this question, so it was pretty simple. I did do a more complicated question down in the timeline section of this video, but you can see on the right there, I did write it down for you, but basically what you need to carry from this slide is the fact that you carry down the accumulated depreciation for your assets to each year. Now, I know that does sound unnecessarily daunting, but it is actually very simple. All that I'm saying is that your accumulated depreciation gets taken out from your cost every year. So as you can see, I've colored there. In year 1 we worked out depreciation as normal and we got 300,000. Then in year 2 we took the 1,200,000 cost price and we minused that 300,000, which was the accumulated depreciation at the time. Then we worked out depreciation again and we got 225,000. And then in year 3, we took the 1,200,000 minus 300,000 minus the 225,000 again. So basically what is happening in diminishing balance method is that you're taking your cost minus your accumulated depreciation at the end of every year. And you're using that amount to work out your depreciation instead of using your full cost price. Now, what exactly does that even mean? Why do we do that? So if you look at the depreciation I have calculated there, do you realize how the depreciation gets less every year? So we go from 300,000 in year 1 to 225 in year 2 to 168,750 in year 3 to 126,563 in year 4. Do you see how your depreciation is getting less every year? And once you see that is happening with your depreciation, you know that you are doing the diminishing balance correctly. And why is that even happening? Because our carrying amount is getting less and less every year. And then at the end of this question, I just worked out accumulated depreciation as of the 31st of December 2019, which in this question was our year end. Alrighty, now we have an example of the units of production method, which is my personal favorite. So basically, all that this method does is it takes a expected amount of units produced by that asset, and you depreciate your asset based off of that. Now, what does that mean? We depreciate per unit. So say, for example, you have a machine and it makes chocolates, and you plan on making 300,000 chocolates with that machine in the useful life of the asset in the company. You will depreciate based off of how many units you are making with that chocolate machine. Does that make sense? So let's look at this question. I'm sure it will make more sense when I explain it. But we have got a delivery vehicle and we bought it on the 1st of March 2017. It cost us $1,200,000 rand, sorry. We have a residual value of 300,000 rand. Now, what is that 300,000 rand? That is the amount that we expect to sell the asset for at the end of its useful life in the business. So once we're done using it, we will take this delivery vehicle and we will sell it to the next person for 300,000 rand. That's what your residual value is, and you take that out of your cost price to get the depreciable amount. And then we have been told here that we use the units of production method, and that we expect that the car will be driven for 200,000 kilometers before we sell it. And then we just have the financial year, and then we have been given a table with the amount of kilometers that have been driven at the end of every year. So if you look at my beautifully drawn little calculation, you'll see that we take the purchase price, which was 1,200,000. We minus our residual value as normal, and we put that amount and we divide it by 200,000. Why do we do that? Because that is the amount that we expect to use the delivery vehicle for. So once we have done that, as I wrote there, step 1, get your depreciation per unit. Once we get that, or once we've done that calculation, we tap that into our calculator, we get 4.5, which means that the car will depreciate at 4.50 per kilometer that is driven. Then from there, it is actually extremely simple, and that's why I think I like it so much. So we have been given, of course, the kilometers that have been driven in each year. So we just take 4.5 or 4.50 and we times each year's kilometers by that amount to get how much the vehicle depreciated per each year. And obviously, by the end of the 31st of December 2019, we had used up the 200,000 kilometers that we expected to use, and therefore that is the end of the useful life for this asset, which means we will sell it, expected to get 300,000 rand back from the sale of this asset. And that is how simple units of production is. So easy, so easy. I'm sure you guys will kill it in the exam if you get it in the exam. Okay, so I'm not going to go into too much detail with this slide because it is pretty self-explanatory, but basically this is just how you account for depreciation in your books and in your financial statements. This specific screenshot that I have right here is from the depreciation for year 3, so year 2019, from the previous slide. So the units of production question example that I did with you, this is accounting for year 3's depreciation. And this is from the slides that your lecturers put up for you, and I think it's laid out very, very nicely for you. So this is a very good slide to have on hand on how to account for depreciation as well. So I thought that you guys would like to laugh with me because I recorded this entire slide, but instead of saying odometer, I called it an odometer. Okay, the odometer. Odometer, yes. So this is a very, very good question. I'm very sorry in advance if I call it an odometer because I've been calling it that for my whole life. But it's actually, I phoned my dad now and I asked him and he told me it's an odometer. So I hope I said right. If I don't, I'm very sorry. But this is a very, very good question. And if I recall correctly, I had this question in my final exam for accounting. So don't get confused with it. It's actually very, very simple, and it's a very good question to ask. So please take note of it. So what the lecturers can do is give you a vehicle, which is obviously an asset, and tell you that it depreciates at the unit of production method. But instead of giving you how many kilometers you drive per year, they give you the odometer readings at the end of each year. Now, what does that mean? Now, I think my boys will know this a bit better than my girls, as much as I'm hoping my girls know this as well. But the odometer is that little thingy that I've circled in the picture, and that tells you how many kilometers the car has driven in total since you bought it. So if the lecturers give you the odometer readings at the end of each year, that is not how many kilometers you have driven in that year. That is how many kilometers you have driven in total since having the car. Now, how do we calculate that? I've done that in the little circles at the bottom. So in year 1, we take 25,000 and we minus 0, because obviously when we bought the car, we bought it new and it had no kilometers on. So we drove 25,000 kilometers in year 1. But now when it comes to year 2, we have to take that 55,000 that we had at the end of year 2, and we need to minus the 25,000, because obviously we didn't drive that 25,000 in that year. We drove it the year before. So we take the 55,000 minus the 25,000, which means that we drove 30,000 kilometers in year 2. We did not drive 55,000. We drove 30,000, which is 55 minus the 25,000. And then same for year 3. We had, at the first day of year 3, we had 55,000 kilometers on our car's odometer. And then at the end of year 3, we had 80,000, which means that we drove 25,000 kilometers in year 3, which is 80,000 minus the 55,000. So I hope this makes sense to you. And then you'll just work out your units of production as normal, and then times your units of production for year 1 by 25,000, year 2 by 30,000, and year 3 by 25,000 to work out the depreciation per year on that vehicle. Okay, we are on to the next topic, which is VAT. This is a good slide. I say that to every slide because I did really put the basics that you need to know per slide. But this slide is telling you now that VAT is calculated at 15%. That is determined by our Minister of Finance, if I'm not mistaken. I could be wrong. But at the moment, it is 15%. It was 14% a year or two ago. And I think I worked out my VAT on 14%. But yours is now at 15%. And then I've just put down there that VAT input is an asset, so it increases on the debit side, and VAT output is a liability, and it increases on the credit side. So what does that mean? VAT input means that SARS owes us money, and VAT output means that we owe SARS money. Once you do the VAT control accounts, once you've balanced it, if you have a balance on the debit side, that means that SARS owes you money. And if you have a balance on the credit side, that means that you owe SARS money. And then that little piece that I put at the bottom of the slide is so important to note, because this will make life a lot easier. Because I understand that people get confused as to what goes under VAT input, what goes under VAT output. But the easiest thing to remember is that everything that goes under VAT input is things that are coming into the business. So if you purchase stock inventory, you will use VAT input. Why? That's because stock is coming into the business. Same with creditors. When you buy stock on credit from your creditors, you'll use VAT input. Why? Because stock is coming into the business. And then obviously opposite for output, once you sell that stock, that means that stock is going out of the business, which means you will use VAT output. And same with debtors, because obviously you sell goods on credit to your debtors, then you will use VAT output. And then same for qualifying expenses and qualifying income. I'm sure you guys know those. But most important thing to note is that VAT input is for goods coming into the business, and VAT output is for goods going out the business. Just a little heads up, this is future Dom speaking. I went and Googled, and the Minister of Finance does calculate or determine the amount of VAT. So I was correct. So like I said, I'm not going to go through this entire question. This is a VAT question, and this is a very good question. Like I said, I'm going to say that for every slide. But I know a lot of people struggle with credit losses and how to account for it. So this question deals basically almost three out of the 4 transactions deal with credit losses. So this is a very good question. And then you'll see in the next slide, I do give you the solution. So I'm just going to go through this very quickly, and then we'll look at the solution. But the first transaction is drawings, because the owner takes goods for himself, and that is VAT output. Why is that VAT output? Because goods are going out of the business. Now, credit losses becomes very interesting, because what you do with credit losses is basically the opposite to what you do with everything else. Now, that sounds scary. Let me explain. So in the second transaction here, you can see it says that you received a letter from the attorney stating that outstanding account of debtor Martin should be written off. And they give us the amount inclusive of that. Now, what does that mean? That means that VAT output that we accounted for previously when the debtor bought from us, we accounted for VAT output. Why? Because goods went out of the business because the debtor bought from us. But now, because we have to write off that debtor's amount of 6,870, we're no longer going to receive that anymore. And how you write off a VAT output, you counteract it with a VAT input. So this is technically not a VAT input, but it was a VAT output that we need to now record backwards, because we're no longer receiving that amount of money, which means we are not going to receive that VAT output anymore, which means we need to counteract it with a VAT input. Okay, so that happens with the third transaction as well, that an insolvent account sends proof of payment. Now, what does that mean? That means that we will be receiving 960 Rand from Miss Barnes, which is a creditor. However, her account was 3,840. Now, we're not receiving that full amount. We are only receiving the 960. So we don't account for VAT for that, because we've already accounted for VAT output when we recorded the sale in the first place. But the rest of that amount, so the 3,840 minus the 960, sorry. So the 3,840 minus the 960, we need to account for that as credit losses, because we are no longer going to receive that. And like I said in the example or the transaction before, we account for credit losses using VAT input, because we are counteracting a VAT output that we recorded earlier in the financial year. And then in the last transaction, we issue Mr. Naidu, which is one of our insolvent debtors. He obviously has now paid us that 9,460. So that is now credit losses recovered. Why? Because we wrote it off previously, but he's no longer insolvent, and he has now paid us the 9,460. So how do we counteract the VAT input, which was the credit losses that we accounted for earlier? We counteracted with a VAT output. I hope that makes sense to you guys, but I will explain it in the solution again. So here, when you look at the solution, I've just put a little bubble next to each of the transactions so that you can see what happens in each of these circumstances. So when we write off a debtor's amount, that is how we do it. We use credit losses and VAT input in our debits, and we credit our debtor's control. If we write off part of our creditor's amount and we still receive a piece of it as well, there is how we account for that. I've also just said they're writing off part of a debtor's amount. And then the last transaction on the 19th was credit losses recovered, and that is how you account for VAT when you're recovering credit losses that you previously wrote off. So remember, when the debtor, so we are looking at Martin's now, so transaction number 2. when Martin's bought the goods, say Martin's bought 50 chairs from us, right? We recorded that as a sale and as VAT output. But now, because they can't pay us that full amount anymore, and we have to write off that transaction, that sale that we recorded when Martin's bought the 50 chairs, we have to counteract the VAT output that we recorded with the sale with a VAT input with credit losses. I hope that makes sense to you. If not, it is all perfectly put out on the slide for you, how you account for credit losses with VAT. So the dreaded timeline that everyone's so scared of, even though it's meant to help us. So I've written down some tips on how to do a timeline, because someone asked me for that. So you'll have 3 different colors. The first color, you will draw lines and label the financial year, so your business's financial year. In your second color, you will label the birthday of the asset or when your interest is payable, if you're doing a interest calculation, of course, payable or receivable, whichever. And then your third color, you will highlight the pieces that fall into your current year. Now, I know that's a bit confusing at the moment, but when we do a question, it will make sense to you. So this was just a random timeline that I saw somewhere, but I just wanted to use this timeline to show you what a difference it makes to actually use colors. So this wasn't a calculation, but if it was a calculation, do you see how easier it is to look at this and be able to work out the different pieces of each of these colors? So say, for example, you had a fixed deposit and you have interest receivable and it is paid quarterly, which means it is paid every 3 months, so 4 times a year. You can easily see here that you will get interest receivable from Jan to March, which is your first piece, so the first piece of your quarter or your first quarter. April to June is your second quarter, July to September is your third quarter, and October to December is your fourth quarter. So this is not part of your work. Don't worry too much about it, but I just wanted to show you what a difference it makes to use different colors and be able to see what is actually happening throughout the year. Okay, so I'm not going to explain this whole question. I did do this with my students when you guys wrote module test 2, I think it was. It's the exact same question I used then, but I just wanted to show you what happens when your vehicle's birthday, so the depreciation of your vehicle, does not match up with your financial year. So you'll see that the asset birthday in our timeline is blue and our financial year is black. And with using that, you're able to highlight the different pieces of the year, and then you're able to do the calculation that I did on the right there. So pause this slide, look at it, see if you understand how it works. If you don't, you're more than welcome to email me and I'll explain it further. But I'm hoping this will be sufficient for you. All right, our fourth topic, so we are almost towards the end, was reconciliation. The person that asked me to specifically do reconciliation on control accounts, so not bank recon. But what reconciliation is in its totality is taking 2 things, so taking your books and taking your bank statement, or taking your list of creditors, so taking 2 systems that you use within your business and checking if they are the same. If they are not the same, you need to identify the problems. That is all that you're doing in recon. I know recon seems very daunting, but it's actually not that bad. All you're doing is taking 2 pieces of information that you are given and looking for the differences. That is your most important thing, and then most of the time you'll have to fix your problems or your mistakes to make sure that your 2 pieces of whatever, your 2 pieces or your 2 systems that you use do equal each other. So you'll be given a bunch of information and a bunch of additional information, and the additional information will help you balance your 2 systems. So in the question that I have specifically put into these slides, We do a debtors recon. So you'll see we get a bunch of information and then we get additional information. And with the additional information, we are able to balance out our debtors control and our list of debtors. All right, our fourth topic, so we are almost towards the end, was reconciliation. The person that asked me to specifically do reconciliation on control accounts, so not bank recon. But what reconciliation is in its totality is taking two things, so taking your books and taking your bank statement, or taking your list of creditors, so taking two systems that you use within your business and checking if they are the same. If they are not the same, you need to identify the problems. That is all that you're doing in recon. I know recon seems very daunting, but it's actually not that bad. All you're doing is taking two pieces of information that you're given and looking for the differences. That is your most important thing, and then most of the time you'll have to fix your problems or your mistakes to make sure that your two pieces of whatever, your two pieces or your two systems that you use do equal each other. So you'll be given a bunch of information and a bunch of additional information, and the additional information will help you balance your two systems. So in the question that I have specifically put into these slides, we do a debtors recon. So you'll see we get a bunch of information and then we get additional information, and with the additional information we are able to balance out our debtors control and our list of debtors. So like I said, you'll be given a bunch of information and a bunch of additional information like they have done in this question. And as you can see, they've asked us to prepare the debtors control account and to reconcile the list of debtors to make sure that it balances. So that is all you're trying to do. And like the picture suggested in the slide before this, you are trying to balance your two systems. So in this case, our two systems is our debtors control account and our list of debtors. They don't equal each other at the beginning of the question, but once you have done all the additional information transactions, you'll see that they will equal each other, and that is all you're trying to do in a recon. So over here I have given you the solution. Like I said, I'm not going to go through the whole question with you. If you do have any specific questions, you're more than welcome to message me or email me. But we had those 6 additional transactions that we noticed were our mistakes in our books. Once those 6 transactions were fixed in the solution, as you can see, you will see that the balance as per debtors control account, which is 55,270, matches up with our list of debtors balancing amount. That is what you're trying to do. That is your aim of reconciliation, is to balance your debtors control and your list of creditors to make sure that they equal each other. And I think a lot of people forget why we actually do this. Now, why do you think it would be important for your debtors control and your list of creditors to be equal to each other? That is because you want your information to be relevant and to be faithfully represented and to be measurable. So you're going back to chapter 1, your conceptual framework. To reconcile your books is to make sure that everything is correct, it is faithfully represented, so that your shareholders are able to make a feasible decision on whether they want to invest in your company or not. And to make sure that all your books are comparable to your competitors, to make sure that it is, as I said, fairly represented. So our 5th topic is trial balance. We are almost there. Hang in there. But basically what our trial balance tries to do is to make sure that all our debits equal our credits. Now, why would we want that? Why do you think it's important to make sure that your debits equal your credits? It's because if they do equal each other, so if our debits do equal our credits, that means that our financial statements are faithfully represented, which means that they are in line with the standards of IFRS. So that is the only reason we do a trial balance, is to make sure that our debits equal our credits, because that means that our financial statements are faithfully represented and comparable and relevant and all that good stuff. So you get 3 different types of trial balances. You get your pre-adjustment, your post-adjustment, and your post-closing. I'm not going to read each of them to you, but basically in FRK 111, you will be given a pre-adjustment trial balance. You'll be given a bunch of additional information with all your adjustments. Your additional information is obviously the discrepancies that you found throughout the year. You will adjust your pre-adjustment trial balance, which will lead to your post-adjustment trial balance, which will then lead to your post-closing trial balance. So yeah, I've put down a really good question for trial balance. Like I said, I'm not going to go through it, but yeah, is the question, and it's a good question to go through to practice for your exam. And I do give you the solution in the next slide. So pause it, maybe do it if you want to, and then you can look at the solution and see if you got the same answers. So when we look at the solution, we are able to see that the debit and the credit equal each other at 49,300. And that is why we do trial balance. So before we did all these adjustments, they weren't equal to each other, which means that our books were not faithfully represented. So once we have made these adjustments, we are now able to see that they equal each other, and therefore our trial balance was correct and faithfully represented. So what I want you to take from this slide is the fact that you will know that you've done a trial balance correctly if your credit and your debit, or your debit and your credit equal each other. You will know that you have done it correctly. If it does not, you did something wrong and you're able to go and find your mistake. But yeah, that's basically what a trial balance is just making sure that your debits equal your credits. And by making sure that your debits equal your credits, that means that you have done your double entry system correctly. I also do just want to put it out there that just because your trial balance does equal each other, so if you have a pre-adjustment trial balance that equals each other, that does not mean that the books are perfect and that you don't have to make adjustments. In your exam, I doubt they'll give you one that is equal to each other, but for future reference, and if you do plan on carrying on with accounting, just know that your pre-adjustment trial balance can have equal debits and credits and still be incorrect. Just because it's equal to each other does not mean that it is faithfully represented. And then lastly, my most requested topic was chapter 10, which is financial statements for the sole trader. And I get it. I get why this would be the most confusing thing for everyone, because it takes the entire semester's work and it puts it in one question. So I get why it's daunting. It's a bunch of letters, it's a bunch of numbers, it's a bunch of words, and you kind of need to take it and put it into one concise question. And I understand why that's daunting to you, but it is also very difficult to reteach the entire semester's work, because that's basically what this chapter does. So I'm going to try and do it as concisely as possible. But chapter 10 is all about practice, because you have to practice entering the right numbers into the right spaces in your financial statements. So you have got 3 statements that you need to know. You have your statement of profit or loss and other comprehensive income. You have your statement of changes in equity, and you have your statement of financial position, and then you have the notes that go along with all of your statements. Can I please just ask that everyone learns the correct spelling for these statements? So it's not a statement of profit and loss, because that's not possible. You can't have a profit and a loss, so it's statement of profit or loss and other comprehensive income. That's the one that most people get wrong, but please make sure that you learn the correct spelling for each of the statements' names. So here I've drawn a little roadmap on how to tackle a financial statement question, to show you how everything actually links up together. But first and foremost, please make sure that you do have your formats for all the statements. I will send a document with formats that I have. They are not the perfect formats. I got them from memos that we got throughout the semester, so they aren't perfect, but they are a good start to help you make sure you have formats ready so that you can just slot numbers in throughout the question. So the first statement that you will tackle will be your statement of profit or loss and other comprehensive income. Once you have done that statement, you will have your profit or loss for the year, which you will then slot into your changes in equity, the statement of changes in equity, which uses your profit or loss for the year, and that will give you your balance or your total amount for equity, which will go into your statement of financial position. Once you have got that changes in equity balance, which is your total for equity, you'll be able to do your financial position. So your statement of financial position, which makes sure that your assets equals your equity and liability, which is your accounting equation. So assets equal equity and liability. And then fourth, which is not actually fourth, but technically fourth, you have all your notes, which are done throughout the whole question. So your notes aren't actually that daunting. All they do is they help you do calculations for your statements. Just slot in totals and not slot in a bunch of numbers. That's basically what your notes are. Once you've done all of that, you will go through the question, make sure that you have slotted all the right numbers in, make sure that you are happy with it and that it is correct. And then finally, number 6, you will celebrate because you got through the daunting, scary question of financial statements. And we have made it to the end. Well done for making it through this. I hope this helped you a little bit. I hope this put your mind at ease while studying for the last bit of your work before your exam. I just want to say well done for making it through the semester and well done on all your hard work. I am very, very proud of everybody and I am very excited to see everyone do well. If you have any questions, please do not hesitate to message me or to email me. I will reply to as many as possible. Our consultation hours are actually over, so I'm actually not allowed to, but I will be able to help a little bit. So thank you so much, guys, and good luck with everything.